Hello and welcome to Sources of Finance. So here we're going to look at different sources of finance, the features, the advantages and the risks. So two types of sources of finance. We've got internal source of finance and external sources of finance. So starting with internal source of finance, first source of finance we've got is retained earnings. Now retained earnings, the main feature of them are they are profits that are reinvested into the business. Now, two advantages. There's no interest or repayment of them, and it maintains ownership and control of the business. Now, the risks. They're limited by profitability, and there's an opportunity cost for shareholders. So that's retained earnings. The next internal source of finance is sale of assets. So basically selling non-essentials or surplus assets that'll bring money into the business. Advantages, get immediate cash, and again, there's no interest to repay or no repayment of the money. The risks, there's loss of future revenue from those assets, and it may impact the operations of the business. The third internal source of finance is the owner's capital. Now, the owner's capital is funds introduced by the owner of the business. The advantages is a quick access to it, just no external approval required or needed. The risks, the amount is limited by the personal savings of the owner, and there's increased personal financial risk. So there's the three internal sources of finance. Now we'll look at the external sources of finance. First one goes bank loans. Now, the bank loan could have a fixed or a variable interest rate, and they are repaid over a period of time. Advantages, the amount is flexible and they're suitable for long-term needs. So bank loans are for long-term needs. The risks, the interest increases cost of the business, and collateral or security may be required in order to obtain the bank loan. Next one's overdrafts, so bank overdrafts. Unlike bank loans, they're for short-term borrowing facilities. They're for a short-term borrowing period. Advantages, there's a flexible use and they're useful for cash flow management. The risks, though, you've got high interest rates and the bank can withdraw the bank overdraft at any time it feels like doing so. Trade credit. So that's basically payment to suppliers is deferred to a later date. So the money you owe your credit suppliers, you delay the payment to a later date. Advantages. It improves short-term cash flow and there's no cost if the demand is paid on time. Disadvantages are risks. Damages supplier relations if you pay late, and there could be penalties for overdue payments. So penalties for overdue payments. Next one is hire purchase. Now here we have installments for the purchase of an asset. At the end of the period of time, the ownership of the asset passed to the organisation. So basically, like have a 3-year period of hire purchase. At the end of the 3 years, you will actually own the asset. Advantages, it spreads the cost of acquisition and with immediate asset use. You get immediate use of the asset. You don't have to wait for 3 years. The moment the hire purchase agreement comes into place, you have immediate use of the asset. Risks, there's a high overall cost due to interest because you're paying interest on the hire purchase, and risk of repossession on default. So if you do not keep up the repayments, the hire purchase company can take over the asset from you. Right, leasing now. Leasing is like renting. So you rent an asset for a fixed period without ownership. So you will never actually own the asset, you just continually rent it, and it's usually for a fixed period. Advantages, lower upfront costs, and the maintenance may be included. So any maintenance on the asset could be included in the leasing agreement. Risks, you do not have ownership of the asset, and the long-term costs can be higher than actually buying the asset outright. Now, venture capital. Here, you have equity investment in exchange for a business share. So an organisation can invest money into the business in return for a share of the business. Advantages. Could be large capital available, and you also get the expertise and networking benefits of the venture capital organisation. Then that can help you in the management and running of your business. Risk, dilution of ownership, so you no longer own 100% of the business. And the venture capitalists, they will expect a high return. So they expect the business to make a high return in profits. Next, we have share capital. It's got raising funds by issue shares. So a limited company sells shares, and in return for selling the shares, it'll receive money, which it can then use to source its business or to finance its business. Advantages, a large amount of capital can be raised, and there's no interest payments. Risks, again, dilution of ownership. So you no longer own 100% of the business, and also there's legal and regulatory complexities behind this. Next one we have is grants. So they are non-repayable funds from governments or organisations. So the government may give the business a grant and it does not have to repay it. Advantages, no repayment or interest, and it encourages specific projects. Risks, competitive and time-consuming applications. So lots of people and organisations will be applying for the grants, and usage restrictions. You only use the grant for specific purposes. Debentures. Now, debentures are long-term loans secured against company assets. There's fixed interest rates, and ownership remains intact, so you maintain ownership of the business. Interest payments are mandatory, and if there's a default, then again, the business risks losing its actual assets. Now, the one thing in debentures, a little bit different than loans, the amount of the debenture is repaid at the end of the debenture period, and during the period, you pay interest on the debenture. Finally, we come to crowdfunding. Now, this is a much more modern method of sourcing finance for business, raising funds from a large group of people via online platforms. Advantages, wide investor access, so you get access to a wide range of people, and it can validate the product demand. So if there's a high demand for the product, you get good crowdfunding. If there's not, then it's telling you that the product is not very viable. Risks, success is not guaranteed, and it may involve sharing equity or profits with the people or the organisations that provide the crowdfunding. So there we have sources of finance.